Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Derek Eichenwald, who's the CEO and Senior Investment Executive with Triumph Capital Management. Derek, welcome to the program.
Mike, thanks for having me.
You're welcome. I always love talking with executives and owners of companies and learning about their entrepreneurial journey because it's always different for people, and I love just hearing how that came about. So give us a little bit of your background and then what led you one day to enter into financial services and then begin to launch and start your own firm.
Yeah, sure. So I started off, when you asked me what led me into this area, I was always very much interested in the stock markets in general. I grew up during the 80s, and of course, during the 80s, there was many movies made and many documentary things like that being made, and that kind of sparked a little bit of my interest about Wall Street and the markets and these types of things. I also found myself as a young man very interested in the business page, and hey, what are all these funny numbers in this area of the business page? Come to find out those were bonds and stocks and these types of things. So while I was in high school, I grew up in Boston, Massachusetts, and when I was going through high school, I eventually went to school out there, and I was selling suits at a small boutique area on Newbury Street. And one of the gentlemen that used to come in was an executive at a New York-based company. And, I was young at the time. So, when you're young and you're in school, you kind of, you don't really inquire too much about people. You're kind of interested in what time do I get out of here so I can get back to doing stuff that I enjoy, right? Lo and behold, he was an executive at a big Wall Street firm, one of the largest in the United States. This is going back some 20 years at this point. And he took an interest in me. And before you knew it, I was working for Salomon Smith Barney down in Boca Raton, Florida. And my phone rang one day, and it was this gentleman that I used to sell suits to during college. And they were starting up a new office out in Denver, Colorado, and that's kind of the beginning of my journey. And I went to work for this big financial services firm. And after I kind of cut my teeth there and everything else, I knew that someday I wanted to kind of carve my own path and carve my own firm. And I went ahead and I did that. And I started up a registered investment advisor. With my relationships and a bunch of people that I knew around the industry, Triumph Capital Management was born. And today we have offices up and down the Front Range, Denver, Fort Collins, Westminster, Canyon City, as well as some outside of Colorado and Nevada, as well as California. And we have about in total 25 folks who work here. And we run a money management and advisory firm.
Neat. I just love how you turned networking and connections and relationships into, parlay that into the next opportunity. And I think that too many times people don't really realize that. I heard a stat, several years ago that about 85% of all jobs are, and I think this was a LinkedIn stat, but are gotten from your connections, your network. And that certainly was part of your journey there. Talk a little bit about how you foster and engender kind of like that relationship with clients so that they realize that, you've got their best interest at heart with some of the high-level advice that you're bringing to them.
Yeah, we truly do. One thing that was very pleasing, if you will, for running a registered investment advisory firm is that fiduciary responsibility and that fiduciary obligation to our clientele. When we meet with clients today, we explain to them, hey, we have a fiduciary duty to you. Our toolbox is unlimited as far as the tools that we can offer you and the financial advice that we're able to to provide to you. We are truly not restricted by a larger company or a larger firm or a compliance department that can't do different products and services because it's outside of their scope. And so, that's explained to our clientele at the beginning of our journey, at the beginning of our process with our clients. We explain what the difference is between a registered investment advisory firm and, the other titles that may be inside of the marketplace. As far as relationships, relationships with the clients that you asked me at the beginning of the question, and networking, we do get quite a bit of referrals from clients. We tend to build long-lasting relationships with them. And from that, over time, sometimes referrals do flow. Back to what you said at the beginning, it's interesting. Whenever we're going to hire a new person, whether it be a new attorney that we're hiring, a new support person, interestingly enough, it seems as though 90% of the time it is coming from relationships. Hey, do you know anybody who does this? Or do you know anybody that does that? And, lo and behold, it's almost everybody who works here is tied from some of those relationships, without a doubt.
Yeah, and I think that just kind of is in marketing, it's called social proof. If I'm going to go, we all have done this. We go to a new restaurant and we're going to look them up online and it's like, oh, look at all these good reviews. Oh, there's a bad review. Yikes. And I think that we need to just realize that when we can set up our, our business, our brand, whatever you want to think of it as, it's based on our reputation. And sometimes that social capital is social proof. And yeah, look at your statement right there is, a huge percent, 90% of your firm, somehow are connected to people. So that's really awesome. Hey, let's talk a little bit, really 30,000 or 60,000 foot view. What are some of your thoughts on, 2021 strategies with respect to money? I know we're coming out of 2020 and there were some tumultuous times in our economy. Do you feel like some of those things are now kind of leveled off and we're moving into the next stage of 2021 and beyond? And what should people be keeping in mind for their finances?
I think we get asked the question all the time, and it's always interesting to me about how somewhat short-sighted we are when it comes to money and investing in the economy. Of course, when we're talking to new clients, folks are saying, hey, I'm so worried about the state of our economy or the state of our politics or the state of our markets. What about this new bill that they're talking about passing for infrastructure, or what about tax increases, or whatever the case may be? For that, I always use my father as an example. My father, I was the last child of three, so my folks had me a little bit later in life. And my dad today is just about to turn 90. And when I talk to him about these short-term headlines as far as, oh, look what's going on here, look what's going on there, there's a new war in the Middle East, etc., what he says to me is, Derek, nothing's changed. Nothing's changed. And I say, Dad, what do you mean by that? And he says, listen, if you go back and you look at any decade, you go back to the 60s or you go back to the 50s, right? There was a point in time where on the front of the New York the New York Post, hey, the end of the world, right? The Russians have nuclear bombs in the middle of the Atlantic Ocean headed for Cuba, right? They're going to be setting up down there, and Kennedy tells them, hey, turn those ships around. You go back and look at these different decades, and if you really kind of replace the headlines that we have today with the headlines of yesterday, hey, Congress is passing this spending bill, or tax increases are coming, or tax decreases are coming, or there's a war in Vietnam, North Korea, Iraq, Afghanistan, he always points out to me is nothing's changed. And so when you bring that back to money, I think, two things that always play into that discussion is, what are clients' goals? What are clients' objectives? How can we get there? How can we create sound portfolios that, regardless of what's going on in the short term, can help meet that client's objectives and goals? And kind of filter out that white noise, right? That white noise, because we all know, at least what's happened since 1926 until current date, is that markets tend to go up, whether we're talking about the real estate market, the stock market, the bond market, whatever the case may be. Today, the Dow's north of 35,000. I remember when the Dow was at 5,000.
Well, remember, I agree with you 1,000%. Remember back when, the 9/11 happened and the whole market just collapsed and people were like, we will never get to 10,000 again. And yep, we eclipsed that. So there's those cycles. And I think that if you, going back to what your dad said, and many people will say, you got to look at the long term. And I think that logically your brain will go, I agree with that. But what about that? The Biden administration said this, and what about this economic event that's going to cause? And I looked at the the CNBC, and I see these line charts and graphs, and things are going up and down. So how do you get out of your head and advise your clients to make sure that you do look at that long term, because things will change and fluctuate? Just let it be, and is there any specific advice, but even strategy that you would recommend? Do you even give some of your clients like sandbox money, like, okay, look, here's your long-term stuff, but here's this little account here. We're gonna make some of those moves. If you feel like you need to call me up and tell me to move this or that, we're gonna do it in this little account. But talk a little bit about how you got to have those peaks and valleys, and how you need to smooth those out.
Yeah, we at the end of the day, we are an asset management firm, and so much of our asset management, I guess what I'll say before I say this is we do craft every client's portfolio individually for them. However, when we go to implement the money management aspect of things, typically speaking, client portfolios are managed tactically. And what I mean by tactically is we move money around. In other words, we might one day have 80% inside of stock with 20% inside of cash or bond. And depending upon what's going on in the short term, we tactically move that stuff around. In other words, we might be all the way down, a few days later to only having 60% in equities, with the rest of it being in quote unquote safer investments, cash or bonds. With that area that's inside of equities, we may be focused inside of the U.S. or we may be focused inside of international, and that may change a week later depending upon those short terms. However, the question about talking to clients, hey, I see this on CNBC, I see these graphs, what about the Biden administration, what about this, or what about that? I always remind people, and I use this particular story, and I'll share it with you in this interview today. I say when I talk to folks, especially new clients, I'll ask them, hey, what's a great investment that you've made? And after about 20 years of doing this, I get the response, real estate. And I say, okay, tell me about the piece of real estate that you own. And the client or prospect responds to me and says, well, I bought this piece of real estate. It was, 30,000 square feet. I bought it back in 1980 for $1 million. And I've been collecting rents, Derek, roughly 50 grand every single year since 1980. And today the building's worth $10 million. And I say, hey, that sounds fantastic. That sounds wonderful. That's you've owned that investment for 41 years approximately. You've collected all these rent payments off of it, and the investment's done really well. And I say, listen, when it comes to real estate, clients have two reference points in their mind: what they bought it for and what it's worth today. And from a psychological standpoint, typically speaking, those 2 points of time have a lot of distance between them. In other words, I bought this piece of real estate 10, 20, 30, 40 years ago for this, and here's what it's worth today. And I say to folks all the time, well, hold on a second. If I take that exact same storyline, and I took that $1 million back in 1980, and let's pretend for a moment that client took that $1 million and they invested it in, let's just say, dividend-paying stocks. Why dividend-paying stocks? Because very similar to their piece of real estate, okay, they collected rents from dividend-paying stocks. And so to bring that down a little further, let's use a company like AT&T. Of course, this is no solicitation for anyone to go out and buy AT&T. I'm simply using it as an example. Client went out there, they put $1 million into AT&T stock. Again, I don't think anybody would recommend that you put all your eggs in one basket. This is just to kind of make an analogy against a piece of real estate. You bought that AT&T stock, let's say that bought you 30,000 shares in 1980. No different than how your building was 30,000 square feet. And let's say at the time AT&T paid a 5% dividend. Well, AT&T paid you, if you put that $1 million into the stock, $50,000 a year in dividend payments. No different than how that building paid you $50,000 in rents. However, your tenant in this case is AT&T versus your tenants that were inside of your $1 million piece of real estate. Perhaps your tenants in the real estate weren't as good. Now, along the way, one problem in my business of asset management is you can log in every single day to your account and see what the value is. You get a statement every single month. Here's what the value is. And let's pretend for a minute 3 short years go by and you open up your statement one day and it says, hey, your account's only worth $500,000, right? And so you call up and you say, geez, Derek, I lost myself $500,000. And I may say to you, Mike, you didn't lose $500,000. You still own 30,000 shares of AT&T. Also, AT&T's still paying their dividends, so you're still going to be collecting that $50,000. Okay? No different than if I were your realtor, let's say, and I sold you the building, 3 years ago for $1 million, and I call you 3 years later and I say to you, hey, Mike, we did a valuation on that $1 million piece of real estate that we sold you. Hey, the market report came back and said that it's only worth $500,000. You probably wouldn't say, oh my goodness, I lost $500,000. You would probably say, I still own my 30,000 square feet. I haven't lost a brick. I haven't lost a floor. All my tenants are still paying rent. And lo and behold, 3 more years go by, and whether I'm calling you up and it's a stock or a bond, and you look at your account statement and it says now your account's worth $2 million. Or I'm your realtor and I say, hey, the building's worth $2 million. You probably didn't say, oh, fantastic, I made $1 million. You probably said, hey, that's the value that somebody's offering for my building today or for my 30,000 shares of whatever company. I used AT&T as an example. But the reality is you said, hey, I'm still collecting my rents or I'm still collecting my dividends. And so people tell me, and this is the end of the story, I've done really well with real estate. And again, I like what you said, Mike, about it being psychological. The reason being is if I did call you as your realtor and I said, hey, you bought the building 3 years ago for $1 million, it's only worth $500,000 today. In your mind, you very quickly make this assumption. Hey, it's real estate. When I bought it, I had a I said, I'm going to hold it for at least 10 years. One. Number two, you probably said, hey, I like getting the rents. I like collecting that $50,000 a year, right, from my rents inside of it. And yeah, I kind of get why the value on it might only come back at $500,000 today because there's a recession going on or whatever the case may be. But you know what? It doesn't really matter. Just continue to send me my $50,000 a year today. In my business, when people start to understand that, they really shouldn't freak out when they see the value of their shares on a particular day being offered for less. Again, over time, typically speaking, if you look at a broad market, whether that be real estate or the broad market like the Dow or the S&P, over time, those values go up, as we talked about earlier. Hey, the Dow will never be at 10,000 again, right after 9/11, and here we are today, and the Dow's north of 35,000. So I always try to put that in perspective for clients and let them know, here's what we're doing with your portfolio. Here's what your returns have been. Here's what the returns have been annualized over an amount of time. And here's what we're doing inside of the portfolio, tactically speaking, to make wise moves. But again, you still own that broad, diversified portfolio.
Derek, that's such a neat example story because I think a lot of people put this big line of delineation between real estate and, investments, and your example of dividend paying and the long term is so spot on. It just helps you go, oh yeah, Why am I going to call my financial advisor and say the sky is falling because I saw this report? When in reality, you wouldn't do that about your house. And my wife and I, we get statement just this week. I think we got 2 postcards from, hey, this house around the corner sold for X. And I'm going, wow, that's a whole lot more than I paid for it, 20 years ago, but doesn't mean I'm going to go sell the house. It just is like it's in one ear and out the other. It's like, okay, cool. The market's moving that direction. Well, back in, if you look at, we talked about 9/11. If you think about the economic crisis, you think about, COVID, there's all of these times that are going to be major blips in the world and the economy. Things, whether it's real estate, house values, and the stock market and your investment portfolio, there's this F word that's going to happen, and it's called fluctuation. And you just need to just realize it's going to happen and know it's normal. It's just going to happen. And if you're in it for the long term, which you should be, you're just going to take it in stride and realize that the plan we put into place is a good one. So I really resonated well with that story. That was really awesome.
Absolutely, yeah, and we do help clients put that in perspective. But, Mike, that isn't to say that we don't talk about the short-term fluctuations or ignore the short-term fluctuations or aren't concerned about short-term news and fluctuations. But if you really think about it, just to share one last little story there, what is the market? So all the market is it's companies that are selling widgets, right? That's it. And so when you look at those short-term reports, if you really take a look at them, you have to ask yourself the question, how will this affect a particular company selling those widgets to the people that are going to buy them? Okay? And then if you break that down just a little bit deeper, inside of any sector, there's competition. So in other words, there's a handful of companies that make a similar widget. Hey, which one of those companies is the best out of that group? Or do I think is the best out of that group? In other words, if they're better than everyone else in the group, they should sell more widgets. And that's all that the stock market is. Okay, that's it. It's just companies that are selling widgets, no different than the company you work for or you own. Hey, you're out there, and how at the end of the day, right, you're selling some widget, whatever the widget may be.
And those minor fluctuations, it's like pivoting. It could be a little minor pivot. It could be a full-on pivot. But you notice them, you observe them, and you have to assess and say, okay, should we tweak or polish our overall strategy? Yes, no. If it's yes, then we're not going to make major changes because we don't want to upset the apple cart. If it's no, then we just kind of recognize it and move on. But yeah, you don't put your head in the sand and say, hey, client, told you this was going to be a 20-year process. So no, we need to observe and recognize that, but realize the long term is there. So I really think that's excellent. Well, Derek, let's wrap up with what's the best way that someone could reach out, connect with you guys, learn more about your firm, and maybe get a second opinion on their strategy.
Absolutely. So again, the name of the firm is Triumph Capital Management, Triumph Capital Management. Again, Triumph is spelled Triumph. So Triumph Capital Management. We can be found on the web at www.triumphcapitalmanagement.com, and you can reach us directly at 720-399-5551.
Derek, thank you so much for coming on today. It was a pleasure chatting with you.
Absolutely, Mike. It was a pleasure chatting with you too, and I really enjoyed it. Thank you.
You're welcome.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.